Remember when President Trump, was appointing the next Federal Reserve chair and nominating people. And essentially he said, I will not appoint someone who's going to raise rates. And all of a sudden we have a Fed chair that talks a tough game, but doesn't seem like he's actually going to do anything. In fact, the odds for September in terms of a rate hike, they're still up there, but they did come down even in spite of his tough talk. And this goes to the credibility of the Fed and part of the reason why the market sold off so sharply yesterday afternoon after or towards the end of the press conference.
Gold, 4,000 is a lock-in. As far as key levels, can it stay above 4,500, which is around the 200-day moving average? It may bounce there. That might be see some responsive selling. Key supports around 3,500. Remember that lock-in last year? It's like the best signal I ever saw between like April and August, and it finally broke out higher. So those are key levels there.
Macroeconomic instability continues to intensify as record sovereign debt levels test the boundaries of global monetary stability. As standard central bank policies face mounting structural pressure, capital markets are entering a profound multi-year realignment phase. Gareth Soloway, a veteran market strategist, together with senior commodity analyst Mike McGlone, observe that unchecked government spending is systematically redefining long-term store of value dynamics. Based on projections of the United States expanding its national debt by $2.8 trillion annually over the next 5 years, alongside sustained global M2 growth, macro models point to an extraordinary gold supercycle. The mathematical average for gold's impending cycle peak is forecasted at $13,000 per ounce. In the near term, technical charts show pivotal support near $3,500 and moving average resistance holding at $4,500. From an independent market perspective, this widening gap between fiscal expansion and tangible asset pricing confirms that precious metals represent the premier structural hedge against systemic currency erosion. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold is the most sensitive to its alternative treasuries. And that's why I like to compare. There's another measure on the terminal. We have a bond, a long treasury bond index. We go back to 1973 with that. If you divide that by gold, bonds are the cheapest versus gold since about 1985. That's the price. Like, okay, well, I'll look at that. And also we hear, everybody knows the fundamentals. Central banks buying, the World Gold Council just had the report today. I get it. We all know stuff we wrote about 5 years ago when I was really bullish gold to break above 2,000, which took about 3 years. So I was wrong on that one. That was the pain. You got the gain. But then we got to such extreme levels. Gold in Q1 reached its highest ever versus the Bloomberg Commodity Index. Now that data we go back to clearly since 1975 when futures started trading, gold futures. That was a bit of an extreme. It got to silver and silver got to its highest ever versus copper and crude oil. Okay, that was a bit extreme. And now we're in the hangover. And the key question is typically when you get this stretched and versus your own moving averages. But the thing also, last year's rally in gold, Jeremy, was so profound. I got lucky in that one, but so scary to me because we have never rallied at such high velocity, the best year since 1979, in a disinflationary environment. PPI, CPI peaked there, what was it, 15%, 13% or so in 1980, and gold ran, and now it's running 3.5%. To me, that was gold warning us, and there's one game left in the stock market. It's the only game left in town, and when that rolls over eventually, if it happens by the end of this year, that's a big trade kicking in. I think gold's winning, and that's the problem now, though. Gold's 60-day correlation to the S&P 500 is the highest ever in an up market for S&P 500. It's telling you if stocks go down, everything's falling because gold might drop a little less. The problem is it trades currently 2 times the volatility S&P 500. That's an annual basis, and typically a store value trading 2 times the value of beta is an oxymoron. We have to be very careful about day trading in quiet markets in July, even August, and making much ado about nothing. This is the next trader. I just remember sometimes you have to step back. Yeah, let the traders knock it around. I used to be one of those. I used to have hair. But maybe gold can get lucky enough to stay above its 200-day moving average around $4, 4,400, 4,500. It might, Mike. But it looks to me very much, the whole industrial precious metals complex looks very much like cryptos did last year. Yeah. And I really enjoyed jumping on the gold horse and getting off cryptos. Yeah, I was early, but pointing out gold. Precious metals are basically a couple doves. There's really 4: gold, silver, platinum, palladium. And gold is beta for the whole metal sector, which is only really 10 that matter. And then there's Bitcoin and cryptos. There's millions of those, and Bitcoin's beta, but there's an unlimited supply. They're like a bunch of pigeons. But they're all rolling over. They all were alternatives, and they all face one key thing. First of all, competition from 5% in the long bond and treasuries and the Fed potentially, and 4% in the 2-year note. And they just went up too much. So to me, those are enduring bear markets are getting started. Gold's 200-day mover is just starting to roll over. Cryptos are clearing a bear market, but the most significant rallies happen in bear markets. They have to rip your face off. That's why I like to just sit back and say, right now I'm still bearish gold. I'll probably put out a really bearish comment if we get to near the 200-day moving average and give us a bounce. But here's the way I look at the way these markets usually work. Typically, almost always, when you rally at this velocity, particularly in silver, it shifts what we're deficits into surpluses. People always forget that. Remember, supply, demand, and price. It's all the same model. Price just moved exponentially. And you put in peaks that last for decades. I think that's already happened in cryptos. I think it's already happened in precious metals. And the next key one is copper. That's where everything for me in Q. If copper goes down, that's the dominoes tumbling because copper is the most highly correlated commodity to the S&P 500. Gold has been hovering at $4,000 an ounce for how long? A couple months now. 4,100 is nothing. Like I said, it's got to get at least above 4,500 just to show potential. It's not a bear market. And then what's that going to do? Is going to bring in more sellers. The thing that surprised me the most was the spike in bond yields. Obviously, because that's my bias that yields are eventually going to go down. Wrong so far, but that's the key thing lesson you learn about markets. Sometimes you have to take the most pain for the most gain. Gold was my great example. I mean, I was bullish gold in the year 2020, 21, 22, and 23. And finally, at the beginning of 24, I quoted Roger Babson, who from 1929, I quoted the opposite what he says. I will tell you what I told you last year and the year before. The stock market's going down. So I just quoted him. I will tell you what I told you for the last 3 years. Gold's going up. Got that trade and got right. But it didn't. It's done. That's the hardest thing in the market to point out is when you move exponentially like this and people say you're technical. I'm like, no. Supply, demand, price. When price moves that much, it shifts supply and demand with a lag. And that's where I think we'd be lucky. So I think what I fully expect though is gold should make it difficult, shouldn't make it easy. I mean, if it goes back to $3,000 an ounce before it goes to $5,000, that would be ideal, might give you a good chance to buy it. If something shifts exponentially, that gives me a chance to signal to be bullish gold. The problem is right now at a 4-decade high versus treasuries, that would be, I can't get really bullish unless somebody gives a, something like a backup. But if it goes back to 5,000 first, I might have to put out a short signal like I did some of that in silver and I did some of that in Bitcoin. Gold's just hard to signal short because it used to be a store of value, but right now its status is a highly volatile speculative risk asset trading at 2 times the volatility of the stock market.
The calculator I created, here's our current conditions. Here's your 5 forces. Debt issuance pace. Right now, we're issuing here in the U.S. $2 trillion in debt a year. Global money supply growth, which is an intricate part of the gold next projection. Right now, it's at 7%. And by the way, you can move these. So you get to play around and make your own thing. We have it set on current conditions, but you can do it. Then you have fiat mistrust. So this is basically fear of the dollar de-dollarization. And then you have real interest rates, right? And ultimately, you can click over to Gareth's base case here, which is if you read the research report, I tell you what I expect. And my expectations are laid out here. It flips it over to what I expect. And they're not ridiculous expectations. It's in the next 5 years, the U.S. is going to have to spend per year or run up the debt $2.8 trillion. There's only $0.8 trillion more on average over the next 5 years or so. But look at what it does. This is the next peak in gold. By the way, this doesn't mean the next bull market. This is when we will peak in the next bull market. And this is my average price. Basically, you have a range here, but the average I would expect between this date will be 13,000. And by the way, you can also, there's also additional things. This is so right now our cycle peak is here. So if that changes, we can adjust this. You can adjust this. If you think the correction is going to be steeper, you can adjust the corrective move, whatever you want to do. There's so many inputs here, but this is a game changer if you are a gold investor.
Key economic indicators signal an impending growth slowdown that will inevitably force monetary authorities into an aggressive policy pivot. The central bank's next decisive move is anticipated to be a sequence of 50 basis point rate reductions, triggering a classic mean reversion cycle in equities and ushering in an economic recession. Consumer price index inflation, having crested at 4.2%, is projected to sink towards 0% during a standard deflationary phase. Simultaneously, crude oil is modeled to plunge from peak levels near $120 down to $40 per barrel if equity benchmarks undergo a 10 to 20% correction. While long-term Treasury yields near 5.2% currently weigh on risk assets. Yields are expected to collapse toward 4% as broader market volatility accelerates. In our view, this looming deflationary cycle represents a classic late-stage trap where overvalued stocks mask underlying economic weakness. Now, let's get back to the interview.
Remember when President Trump, was appointing the next Federal Reserve chair and nominating people. And essentially he said, I will not appoint someone who's going to raise rates. And all of a sudden we have a Fed chair that talks a tough game, but doesn't seem like he's actually going to do anything. In fact, the odds for September in terms of a rate hike, they're still up there, but they did come down even in spite of his tough talk. And this goes to the credibility of the Fed and part of the reason why the market sold off so sharply yesterday afternoon after or towards the end of the press conference. Now, listen, when all is said and done, there's multiple factors running into this market sell-off we saw yesterday. Obviously, semiconductors have been under pressure, although I will reveal that I did do some buying, some major buying on semiconductors yesterday afternoon and even after hours when they were dipping more. I'll reveal some of those buys.
I think the next move from the Fed will be a series of 50 basis point cuts and a normal reversion cycle in the stock market, which means a recession, but that's all that matters. Otherwise, there's no reason for them to do anything. I mean, they can't really hike rates. For Mr. Warsh to hike rates would be a complete profile and courage, which I think is very unlikely. Now, it could happen, particularly as his term moves past Mr. Trump. All we care about right now is what happens in the second half of the year. It's so profound. But the bottom line from inflation's elevated. And the key thing, I think the market's going to look back from the future and say, duh, that was dumb. For the Fed to be cutting rates in an environment with stock market running 2 times GDP, and this is the last few years, and inflation above their target, and bond yields going up and telling them not to cut rates. So just give me a look back from the future and said, yeah, we're not going to do that again. And I think Warsh is saying it, but he's not really doing anything. And I think the simplest thing for the Warsh to understand, and I think him and Besson get really, they're ex-traders, is 'tis the season for volatility to pick up. I mean, it's end of July. Only thing you got, when at the end of like May, you got to look forward, you have to look forward to the summer and the moribund season. Now we're looking forward to the fall, which might mean a fall in prices in certain things like a stock market. And we have indications. I look at things like the Kospi, it was up 110% on the year. Now it's up 30%. We've had pumps and dumps in versus all the metals, gold, silver, platinum, palladium, and Bitcoin. And they're hovering down. To me, the signals I'm seeing from markets, also with volatility in the stock market running their multi-decade lows versus the volatility you see in gold and crude oil and things like that. Just a little bit of reversion in that, I think, is what we have to look forward to. I think the Fed gets it, and I think they understand it's all they need is a little backup in the stock market. Poof, everything's fine. Inflation will be alleviated. All that excessive spending and the wealth effect will be removed, and then they can think about easing. But right now, to hike, good luck. That's not going to happen. But if inflation stays sticky, they might have to. And here's the key thing that's changed, Jeremy. This is how the world has changed, how the answers have changed. And that is, in the past, for president would pressure the Fed to ease rates to boost the economy, help them get elected. Now, what that does is create more inflation. It's the number one issue in the elections. Midterms are coming up, and inflation means incumbents are not getting elected. Inflation, simplistically, has probably peaked. I'm going to put that in my headline for my August outlook for commodities. I think inflation's peaked at 4.2%. That's CPI. I think crude oil's peaked at 120. And the key thing I have in the headline for next year, I fully expect CPI can easily get to 0% and crude oil can get to near 40 on a normal cycle. There's one key prerequisite for that, just to say a 20% drop in S&P 500 that stays down, or even a 10% drop from here now. That's the way things usually work. We're so overdue for a post-inflation deflation cycle. And if you could think of what's happened with crude oil and CPI, they both kind of peaked from lower highs, lower plateaus since the peak in 2008. Now, inflation obviously had a little run when Russia invaded Ukraine, and they've made lower lows since. Has that trend stopped? But that's also happened with stock market cap to GDP reaching the highest on a year-end basis since 1928, and most significantly, stock market cap to public debt reaching 1x or so. That's the highest since 2007. That's part of the reason bond yields are the highest since 2007, which is a major pressure for all non-income producing assets and commodities, most notably precious metals. Number one thing for my call that has been wrong for almost 3 years now, and bond yields to be the next big trade. That's my main call for this year. Is the stock market has to go down. So I look at that long bond as we speak 5.21%. That's a huge headwind for any non-income producing asset, starting from Bitcoin to gold. There's no reason. I mean, you got to have some major inflationary forces to make those viable versus a 5% long bond in U.S. Treasuries. But the bottom line is the number one source for inflation is the U.S. stock market. It's still up almost 10% on the year. That's if it drops 10%, that's 25% of GDP, the most on a year basis since 2008. So I look at Treasury bonds right now as basically a put on the stock market with positive carry and no time decay. Puts, as you know, in my experience trading puts, I oftentimes will be right on the market. My puts will expire before I get a chance to be right because I'll be wrong first. But to me, that's the way they are right now. And the bottom line is this second half of the year will be the major determinant. I'm looking at it, it's going to be either a ho-hum year, stocks going up, which means you're probably not going to make much more in treasury bonds. If the stocks drop, that 5.2%, I think it's going to drop towards 4% in a heartbeat. And if stocks stay down, it's a major cycle kicking in, very similar to what we had in 2007.
That correlation's crazy, huh?
Yeah, so that's the key thing I want to point out too, is I love when people point out is the unstoppable deficit spending. It's not just in the U.S. You see it picking up in the rest of the world, and most of all, we have it very high in China, and it's picking up in Germany and Europe because of defense spending. But I like to point out, total U.S. debt in this country is between $39 and $40 trillion. Sure, that's unstoppable. I get it. But U.S. stock market cap is over $80 trillion. That's 2 times. It's the highest since 2007. U.S. debt in this country, that liability is minuscule versus that top asset that's real time, the stock market, at 2 times that. That's the last time we had bond yields at these levels. So I'm still very comfortable with that call. It's on the back of selling gold and selling Bitcoin at really stupid levels that just got too expensive and hiding out in treasuries. So that's still my main theme for this year. That part's been wrong. You haven't lost a lot, but that's where I think this next second half is going to matter, Jeremy. If we start trickling down in the stock market, particularly later in the year you do it, that'll accelerate the trend for, it could be certainly for a couple of years, but certainly next year. And that's what I'm thinking. You always look at iterations. Okay, if this and that. So if stocks stay strong, okay, fine. Fed might have to tighten, or kind of a ho-hum, boring market. But if we start ticking down the stock market, what's normal in this type of cycle, that's a big trade. And treasuries are the place to start. And that's what I think we're seeing warnings from things like Bitcoin going down and gold failing, and even the Kospi rolling over. It's only July. And we even got through August yet. Just wait till we get through closer to the midterms. This is going to be a fun quarter. And so bottom line, I'll end with this. I think it's going to be a trading year of a lifetime. Maybe similar to 2008. It's just getting started. And some of the key themes have already happened. Bitcoin's broken down. Silver's broken down. Gold's broken down after key rallies. And then 2 main things I've gotten wrong so far is copper. I didn't think it'd stay much above $6 a pound. And I didn't think that bond yield will stay much above $5, 5%. So far, we'll see how this works out towards the end of the year.
Cross-asset signals indicate a significant structural repricing across commodities, equities, and alternative stores of value. Parabolic rallies across metals and speculative assets typically convert tight supply deficits into market surpluses over extended cycles, capping upside momentum. Technical analysis indicates gold could experience a deep corrective pullback to the $3,000 level before consolidating for a sustained leg higher toward $5,000. Industrial metals like copper are showing weakness above $6 per pound, acting as a crucial leading indicator for upcoming stock market stress. Meanwhile, U.S. stock market capitalization relative to public debt sits at a precarious 2.1x ratio, mirroring dangerous valuation extremes last seen in 2007. Long-term Treasury bonds offer an exceptionally attractive risk-reward profile, operating effectively as a positive carry stock market put option without time decay. Analyzing these cross-asset dynamics reveals that smart money is quietly shifting from high beta speculation to capital preservation strategies. As market volatility builds into the midterms, these compounding factors will accelerate aggressive asset repricings globally. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.